Hey everyone, and welcome back to another video for today. So as we can see, on Tuesday we've got green across the board. Remember, on Monday the markets were closed, so we did not get that impact from, well, the conversation between Donald Trump and Ursula von der Leyen on the 50% tariff that should have started at the start of June. Now that's postponed until early July. We'll see. We'll see what happens. I was very surprised on Friday that the market didn't really end deep in the green. We've also had the rising 10-year yield, 20 and 31, after that big beautiful bill did pass the House, might not pass the Senate, so maybe that's why the impact was, let's say, controlled. But on Monday, European markets were already green. On Tuesday, they were green again. And now the US is open on Tuesday. So we've got here green across the board. Now in this video, I do want to touch on companies that are not in the green. Companies that have seen their stock hit 30%, 15%. So we're going to talk about FICO, the whole story behind that, and Pinduoduo, a company that did report their quarterly figures before the market opened on Tuesday. Stock was down closer to 20% at the start of the day. Now it's down a little bit less than that, but we're going to talk about those two companies. Of course, if you are following other companies that have not followed the recovery in recent days and weeks, but are still good value, do let me know down in the comment section below. I might just do a separate video talking about the energy stocks, specifically those that have been hit, right? The First Solars, the Enphase, maybe even some nuclear stocks as well, although those ones have not been hit at all. So maybe that will be the idea for another video, but do share your companies that are maybe undervalued, flying under the radar, down in the comment section below. And if you enjoy this type of videos, hit all the buttons. We really appreciate that, especially the subscribe one. Trying to reach 100,000 subscribers as fast as possible. So hit that subscribe button. It's free. Why not? And if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so first up, let's talk about FICO. FICO at the time of making this video is down another 11%. This is a company with a market cap of $41.2 billion. A very high PE, whether it's trailing or forward one, but this is of course a high margin business. Now, right now, as you can see, this is a stock that is experiencing a drawdown of 36.8% since the peak, okay? Since the peak. Now, year to date, if you look at year to date, it has a drawdown of 31.7%, with the big move, of course, happening just in the past week or two. So what exactly is going on here? We did talk a little bit about FICO, I think last week, in a major overview of what is going on in the market. But if you missed that, I'll go over it again. So why the drop? Well, the Federal Housing Finance Agency, FHFA director, publicly criticized FICO's pricing strategies, calling for more affordable credit assessment options and suggesting privatization of Fannie Mae and Freddie Mac. And I didn't even know that the director was Bill Pulte. I don't know if you've been following him on X, but he was the guy that previously did give away quite a lot of money just on social media. Now, whether that was just a shtick or not, I don't know, but he's now the director. So this raised fears of regulatory changes and increased competition in the credit scoring market. As I said previously, this is basically, again, attacking a business that has, well, a competitive advantage, pricing power as well. So just like with other businesses, when they get attacked because they're too strong, the stock goes down. But the reason the stock goes down is because the company is just so good. Now today, Bill Pulte again tweeted out, and that's why the stock is down another 11%, to which Joseph Carlson actually answered to, well, a specific post, and he said the following: "Do you mind explaining how FICO's pricing is a bigger and more pressing concern to home buyers than mortgage brokers' fees or realtors' commissions? For reference, you would need approximately 180 FICO pull requests to equal the fee of one mortgage broker transaction. You need to pull your FICO score 600 times to equal a single realtor commission on a home sale. Other than the significant amount of lobbying brokers and realtors do, what reason do you have to focus on FICO more than these other costs?" And I mean, as per usual, I guess he makes a good point. Now, someone else posted this from the Broker Action Coalition: "Rising costs of credit pulls. Enough is enough." Now, what is a credit pull? Anytime an individual's credit score or credit history is checked, most often by a lending institution, a credit pool occurs. There are two types of credit pools, hard pools and soft pools. Historically, hard pools are more comprehensive and cost more than soft pools until recent price increases from FICO. So they say here that the increase and how that affects the home buyers is, well, up to 700% per increase in 2024. So prior to 2023, the average cost was $14.5. Then from 24 to 25, $80 unregulated FICO cost. And they say here a single credit report may increase up to $80, with two-person reports increasing to over $100, which then leads them to this number right here. Now, I did some digging and some research. So FICO's fee increase is only 41% per score, 183% for a two-person report, not 700%. The majority of the 700% total cost increase comes from credit bureau fees and lender markups, which rose 1,657%. The total cost of credit pool has indeed risen $700 from $14.5 to $80 to $100, and this impacts home buyers. However, attributing this entirely to FICO oversimplifies this issue, which goes back to the post Joseph Carson made. And yeah, you can start asking maybe the better questions here, especially that last part. And of course, all of that story has led to FICO coming down. Now, if we look at FICO's pricing, right? If you look at trailing 12 months PE, we can see that yes, it did come down quite a lot, but we're still at 64.2 times. Okay, 64.2 times trailing 12 months PE. On average, we were at 49.5. So on average, over the past 10 years, this has never really been a cheap stock. Yes, we were lower, yes, we were higher, but on average, we were lower than where we are right now, despite the recent pullback. Now, looking at the forward PE, that sits at 45.8 times. Here as well, despite the recent pullback, we are still higher than the 10-year average. So yeah, I guess this was just a stock that needed a pullback, regardless of the headlines, because how much were you willing to pay for this business, regardless of how good of a business this is? They generate revenue here through two segments. So you've got total on-premise software revenue and total scores revenue. Total scores revenue, as you can see, have been increasing, especially over the past 12 months or so. The other one, not by much. Over the last 4 years or so, total on-premise software revenue has grown at a compound annual growth rate of 10%, while the other by 15.2%. As I've shown you previously, if you look at total ARR, yes, that has increased over the last 4 years, also at a compound annual growth rate of just over 10%. But if you look at the year-over-year growth, well, the growth rates have decelerated quite significantly. Now, okay, you might say maybe this is close to the bottom and then we're rising yet again. Yes, this is definitely a possibility, but you have to look at that trend. Same here with total dollar-based net retention rate. That was 120 when we peaked right here, September 2023, and now we're at 102. So yeah, where is the bottom is the question. And then looking at the current analyst expectations for the upcoming years, free cash flow growth, free cash flow is expected to grow rapidly. Okay, in the next coming fiscal years, revenue is expected to grow nicely as well. Currently, right? Of course, if there are some regulatory changes, then that will impact the estimates. But currently, this is still a very good business. Free cash flow margin, gross profit margin had, of course, increased over the past 10 years. Free cash flow margin here, as you can see, sits at 38.2%, with gross profit margin at 80.8% and increasing. As you can see here, free cash flow specifically is expected to increase by 16 well, if we take the last 5 years and then we look at the forward 2.5 fiscal years, it's expected to grow at a compound annual growth rate of 20%. Now, of course, here, as always, you have to ask yourself the question, am I willing to pay the price for this business? The business is a great business, quality business, very strong, you might even say a monopoly of some sort. But as I've shown you, despite the pullback, well, there are still some questions to be asked, right? How much of a premium does this deserve still, right? How many years of future growth am I paying for today? Are we going to see a rebound pretty soon? Remains to be seen. This is a business, of course, that has done very, very well over the past couple of years, which you can see right here. Over the past 5 years, this stock is still up 280%. Now, of course, you are not buying the FICO of the last 5 years. You're going to buy the FICO of today and the next couple of years, if not decades. And that's the thing. Are you willing to pay the price right now, or should you wait even more? That's a question that only you can answer. If you want my opinion, I still think that this is a, well, good business, but extremely expensive. Moving on to Pinduoduo. As you can see, Pinduoduo is down 14.6% on Tuesday at the time of making this video. I'm showing you here the 3-year chart with the drawdowns. And as you can see, the stock did experience drawdowns of over 40% numerous times over the last 3 years. Currently, we are experiencing a 35.3% drawdown from its peak. Now, year to date, of course, now with that decrease, we are experiencing a 22.4% drawdown. Now, this is a company that right now is still expected to grow quite rapidly, whether it's revenue or EPS. Valuation-wise, as with plenty of Chinese stocks, it is very cheap. Okay, trailing PE here, 11.3 times. A price target, by the way, is well, 50% higher than where we're at right now, and a forward PE of 9.7 times with a forward price to free cash flow of just 8.5%. This is a company with free cash flow margins of 30.7%. And I know what people are already going to say. Yeah, but maybe the numbers aren't true. Okay, maybe they're not true. I assume that they are. Otherwise, yes, I do think that they would already be delisted, or we would have had an SMCI type of scenario. Now, what exactly has happened this quarter? So, revenue increased just 10% year over year. Operating profit did decrease 38% year over year. Non-GAAP operating profit decreased 36%. Net income attributed to ordinary shareholders decreased 47%, and non-GAAP did decrease 45%. Now, they said the following. In the first quarter, we made substantial investments in our platform ecosystem to support merchants and consumer amid rapid changes in external environment. These investments weighed on short-term profitability, but gave merchants the room to adapt and focus on high-quality, sustainable growth, strengthening the long-term health of the platform. Amid growing uncertainties, we see enhanced merchant support as essential to building a healthy merchant ecosystem that can deliver satisfactory shopping experiences for customers. This is why we have made this strategic decision to increase our ecosystem investments to drive sales and reduce costs for a broader base of SME merchants. As communicated previously, a slowdown in growth rate is expected as our business scales and challenges emerge. This trend has been further accelerated by the changes in external environment in the first quarter. Our financial results may continue to reflect the impact of sustained investments in the ecosystem as we support merchants and consumer through uncertain times, which to me translate to them telling us already that don't expect a turnaround this quick. Now, the problem that I have here, one, it's funny how things change, right? Because a while ago, it was Alibaba that was not growing that much, and Pinduoduo taking more and more market share, growing much quicker. And now Alibaba actually had a very good quarter, plus Alibaba has the cloud business. And here we're now in a case where Pinduoduo is not doing as good as expected. Here we can actually see, you can now see that this part right here, which is transaction services, did come down quarter after quarter. Yes, it's still up year over year, not by much, but quarter after quarter, that is down. And we see that overall here, that revenue is also down quarter over quarter, although the December quarters are usually the best ones. But yeah, the fact that transaction services is down, maybe that's a consumption issue, maybe not, remains to be seen. Overall, if we're looking at the bigger picture, here we can clearly see gross profit margin have peaked back in 2022, 75.9%. We're now at 60.9%. Free cash flow margins have also peaked closer to 40%. We're now down to 30.7%. And these were actually numbers just from Q4 2024. I can still not give you the updated one, but the trend here is, I guess, the issue. Looking at what's expected from the company, and of course in the coming weeks these expectations will definitely change, but as of right now, revenue is expected to grow still rapidly in the next 2 fiscal years, well, of course less rapid than before, still 18.4% year-over-year growth in fiscal 26, but then a very big deceleration, just 10.3% year-over-year growth in fiscal 2027. Now, the thing here with Pinduoduo is that if you look at their total cash and short-term investment, well, at the end of 24, that was $45.42 billion. So the price that you're paying right now for that company, yes, a lot of it is just, well, for the cash position. And I know people are going to say, yeah, but look, why aren't they buying back shares, right? If the shares are so cheap, if they're still generating free cash flow, etc., why aren't they buying back more shares? It just doesn't make much sense. Mismanagement. To be honest, I would agree. I would agree here. If the shares are just so cheap, if you can still continue to grow, because this is still a business with, okay, very good margins and it's still growing. So why not, right? Why not reward shareholders? I understand that you want to invest in the business, as they tell us here. But if the shares are just so cheap, this is something that Alibaba also did, right? Shares are extremely cheap, so they're buying back more shares. For Pinduoduo, I'm asking the same question here. Why aren't you buying back a ton of shares? Can't you do both? I think you can, right? So either the shares are cheap enough, but maybe right now, yes, there is a slowdown, and maybe that will impact free cash flow and all of that. And that's why they're not willing to buy back shares. Okay, I'd say this is maybe a weak explanation. But yeah, they do. If you do look at the cash and short-term investment, this is definitely something very good to have. But yeah, this is still a Chinese stock, so that's why it's also trading at such cheap valuation. Although, as you can see, year to date, it is still up at the moment. It's still up 5.2%, but in the past 12 months, it is down 31.9%. I have no position in Pinduoduo anymore. As you know, I made it, well, my only position is now Alibaba when it comes to China. I had both of them and I decided to just go with Alibaba because it gets me the e-commerce side of things, but it also gets me the cloud side of things, which basically means I have a Chinese Amazon on my hands. So yeah, there is opportunity, right? There are opportunities for sure, especially in this market right now, where it does seem like every other US company is expensive, right? Even the FICO one we've just talked about. Yes, it is experiencing a drawdown, but even after that drawdown, on average, if you look at the PE, it still is much more expensive than historically. And so all in all, that's about it. It was a great day on Tuesday, green across the board. Well, green across the board if you're not FICO or Pinduoduo. So that's about it. Like I said at the start of the video, if you have great companies that have been beaten down quite a lot, I know we've been talking about United Health a lot, do let me know down in the comment section below, and I'll try and cover as many as possible if I understand the business and, well, if it makes sense. So let me know down in the comment section below. Hit all the buttons, especially the subscribe one, and I'll see you all in the next one. Bye bye.